Welcome to CoreLogic's Housing Market Update for September 2024, brought to you by First National Real Estate. The pace of value growth continued to cool through the final month of winter, with CoreLogic's National Home Value Index rising by 0.5%. This was the 19th straight month of rising values at the national level, but the rate of growth is clearly slowing and now less than half the rate recorded at the same time last year. At a high level, there's still more demand for housing than available supply, but the flow of advertised supply and demand are becoming increasingly balanced. Supply levels vary markedly from region to region, with total listing numbers in Melbourne now almost 30% above the previous 5-year average, while total listings in Perth and Adelaide are tracking close to 40% below the 5-year average for this time of the year. Capital growth across the cities remains diverse, but continues to be led by the mid-sized capitals, where values are rising at 1 to 2% each month. The monthly pace of gains across Sydney has slowed to 0.3%, while Melbourne, Hobart, Canberra and Darwin all recorded a monthly decline in home values. The quarterly trend rate of growth eased in most capital cities through winter, which can be attributed to a combination of seasonality, but also worsening affordability constraints, persistently low sentiment and lower borrowing capacity. While affordability is improving in markets like Melbourne and Hobart, where values are trending lower, it's hard to see housing values continuing to rise at the same pace in the mid-sized capitals as affordability becomes increasingly stretched, particularly in the context of elevated interest rates, loosening labour market conditions, and cost of living pressures. The ongoing outperformance of cheaper markets reiterates the strain on demand. The lower quartile of the combined capital cities market, which makes up the most affordable 25% of dwellings, rose by 2.7% in the 3 months to August compared to a 0.3% lift across the upper quartile. In a similar demonstration of demand being deflected towards lower price points, the quarterly change in unit values was higher than houses in 5 of the 8 capital cities as buyer demand shifts towards the lower price segments of the marketplace, supporting values at the more affordable end of the pricing spectrum. August also marked a few changes in the hierarchy of housing values across the capitals, with the median dwelling value in Melbourne overtaken by Adelaide and Perth, making Melbourne's median the third lowest amongst the capital city markets. This is the first time that Perth's median dwelling value has been higher than Melbourne since February of 2015, when Perth was coming off the highs of the mining boom. It's also the first time in CoreLogic's 40-year median dwelling value series that Adelaide has had a higher median than Melbourne. The higher median dwelling value in Perth and Adelaide relative to Melbourne is a combination of values moving in different directions, rising rapidly in Perth and Adelaide while falling in Melbourne, but it's also a compositional difference in housing stock, where a high proportion of medium to high density stock in Melbourne tends to weigh down the median dwelling value. In Melbourne, about a third of homes are units compared with about 16% of homes in Perth and Adelaide. Switching focus to the rental sector, relief for renters is in sight as growth slows to a halt. Our national rental index was unchanged for a second consecutive month in August, and rents declined in Sydney for a second consecutive month. While rental trends are typically softer through the middle of the year, the annual growth trend is also showing a consistent slowdown in rental rises. Nationally, rent values are up 7.2% in the year to August, which is still more than twice the pre-COVID average, but it's the lowest annual growth rate since May of 2021. Annual rental growth is now slowing in every capital city market except for Hobart, which is coming off a dip in rent values through 2023. The slowdown in rental growth is attributable to a combination of supply and demand factors. On the demand side, net overseas migration has dropped, with ABS data showing a decline from 165,000 in the March quarter of 2023 to 107,000 in the December quarter, and overseas arrivals data is pointing to a further fall in international student arrivals. Additionally, the latest RBA reporting on average household sizes shows a slight uptick, suggesting share housing or multi-generational family homes may be back on the rise in response to higher rents. On the supply side, investor trends vary from state to state, but nationally investor loans secured were up 10.7% in the year to June. Dwelling completions remain an issue, with a strained construction sector keeping a floor under both rent and purchase prices. Brisbane dwelling values were up a further 1.1% in August, adding approximately $9,200 to the median dwelling value. Although the pace of capital gains remains significant, the Brisbane housing market is losing some momentum, with the quarterly pace of capital gains slowing from 4.5% a year ago to the current rate of 2.9%. Brisbane's unit sector is now showing a substantially higher rate of growth than houses, with unit values up 5% over the past 3 months, while house values rose at half that rate. Similarly, the lower quartile of Brisbane's housing market is recording more than double the quarterly gains across the upper quartile, at 5% and 1.8% respectively. The stronger performance across the unit sector and lower value quartile is probably a reflection of affordability constraints deflecting demand towards lower price points in the market. Looking forward, the national housing market should continue to see modest value increases through to the end of 2024. While there's a clear slowdown in growth, housing values are underpinned by a longer-term lack of new supply, which has been exacerbated by ongoing constraints in the residential construction sector. The latest statement of monetary policy from the RBA highlighted that finishing trades are in short supply and the public infrastructure pipeline is creating greater competition for labour and input materials, especially across the multi-unit sector. Tight job markets continue to support mortgage servicing, however, a more substantial loosening than expected in labour markets remains a key risk for housing values. Tax cuts and energy rebates are improving household finances, but they may not necessarily translate to a boost in home buying. We did see consumer sentiment tick a little bit higher in August, buoyed by Stage 3 tax cuts, the cash rate remaining on hold for a sixth consecutive meeting, and lower inflation expectations. However, sentiment around dwelling purchases continues to decline despite an ongoing expectation that housing prices will rise further. Housing affordability continues to be a key factor impacting on demand, with a widening gap between what would be considered an affordable home for a household on the median income and the actual dwelling price. CoreLogic puts the estimate of an affordable purchase price at about $500,000 for the median household income, against a median dwelling value that's currently sitting at $802,000. This discrepancy has likely channeled demand towards markets with lower price points, including the unit sector and housing markets located further away from key amenities. Spring sellers should be aware of the differences from market to market. Heading into the spring selling season, there's no guarantee that buyer numbers will rise to meet the seasonal uplift in listings. While total stock levels remain generally low across the country, there are some markets, mainly across Victoria and Tasmania, where total listings are now accruing. In such a varied market, those looking to buy or sell this spring should be conscious of local conditions, such as the number of properties currently on the market, the amount of time properties take to sell, auction clearance rates, and price movements. As always, there's plenty to keep an eye on in the housing market. You can stay tuned to all the twists and turns at the research and news pages of the CoreLogic website.